All right, Dom, let's start with the markets. Our next guest is sticking with a new year, new bull market stance and says the biggest risk is a turn higher in inflation next year. Joining us to talk markets, the Fed, inflation and earnings, Hugh Johnson, Chairman and Chief Economist with Hugh Johnson Economics. And joining us throughout the hour, happy to say, is CNBC contributor Courtney Garcia, Senior Wealth Advisor with Payne Capital Management. Courtney, good to have you with us in studio. Good to see you here on this side of the Hudson for a change.
Yes.
Usually over at NASDAQ. Hugh Johnson, welcome. Good to see you. Happy New Year.
Thank you. Happy New Year to you, Tyler.
You keep doing this, Hugh. You keep doing this year after year after year. I keep trying to catch you. I can't. So you think a new bull market began back in October, and you think it's got legs?
Oh, yeah, it definitely is. Bull markets go, if you look all the way back to 1890, you've got the average bull market being 47 months. And if you look back to the post-war period, post-World War II, you've got essentially 63 months. So we're at let's call it the 2-month mark, maybe 3-month mark. And when you've got bull markets that last that long, on average, this one's got a lot longer to go.
What was the demarcation point that you think set this bull market off and running?
Well, it's a number of things, Tyler. I think the number one thing is the performance of the financial markets generally, not only the decline in interest rates, but the most important thing was the performance of different sectors of the market. You saw the so-called bull market sectors like consumer discretionary, industrials, and technology stocks doing well. And I think the real tip-off, at least for me, was that for a long time, small capitalization stocks were lagging large capitalization stocks, and that all changed. And that changed in October. And I think that's the signal that a new bull market has really begun. There's a lot of other things that tell you that basically when you look at cycles all the way back to 1890, it's starting to shape up as being a very somewhat normal cycle.
Hugh, it's Dom. One of the big things that we talk about, speaking of that cyclicality, is this idea that we are now in an election year, and we've talked a little bit over the course of the past several weeks about some of the moves that we typically see in those election years. Do you feel as though there's a risk out there because of the political situation in America right now for any kind of enhanced market volatility?
Yeah, there's always that chance. There's always a chance of some increased volatility. I'll be honest with you, Dom. I don't believe that the outcome for the election, or let's say the potential outcome or what people think will be the outcome of the election, is going to have much of a bearing on what the markets do, what the stock market and bond market do in 2024. The number one things are going to be the same things that you and I worry about all the time, which is what's the economy doing? What are interest rates doing? What are interest rates and earnings doing? Those are the things that ordinarily drive stocks. And when you get away from the election, just a little bit away from the election, you'll find that those are the things that are going to make the difference in 2024 and in 2025, because we're headed towards 2025, which will be an equally important year.